Good morning from Melbourne again. This is part two to our second chapter, or say quarter two, of the Travis Fulton interview. I'd like to welcome Travis back, and again, thanks for your input. Today I want to, in this episode, I want to cover, just very briefly in a couple of minutes, what we think is happening with foreign money coming into Australia, some of the effect, positive and negative, that some of the Trump policies are going to have in relation to the tariffs. So we'll get started. I think on the US situation, it's interesting watching Trump seems to have this morning taken a little bit of a backseat in relation to putting the tariffs on Australia. He sort of mentioned that he goes in pretty hard initially, and then he always sort of softens up his spiel days later. And that, he's obviously a great businessman, so I don't know whether that is a strategy that he uses. It seems to happen quite a bit. But the reality overall is that stuff puts a lot of scare into the economy, and as we know, economies are perception-based. And one of the things that probably worries me a little bit is the effect that it has in our general market. Now, what I see now is that those sort of things, people might not necessarily understand them, but it can affect people in relation to doing something else because they're not sure what's going to happen with iron ore in Australia, and they know iron ore is a fairly big export here, etc. Now, and I'm getting to my question. So now on that score, what we see is the eventuality now of a market that is very, very perception based, right? And running in a little bit of fear. So therefore people are reacting or not reacting, for the want of a better term, in relation to spending money or allocating funds to buying another house, upgrading, or buying investment property, etc. So having said that, then the question for me is, if we're dealing with the issues that we have with APRA in relation to regulating the banks even tighter. We've got some of the foreign issues in relation to Trump, etc., and some of the tariffs that he may or may not lodge. And then we've got China. And we've had a very high dependency on China and the inflow of money coming in, which is actually, as you mentioned before, you think it's dried up. Is that what you experienced?
It's drying up.
Right. That means to me that the policy restrictions in China in relation to outgoing money, if he remains in power, will remain.
Yes.
So therefore, we've got a market that's changing its dependency upon the Asians, then into other nationalities. So therefore, aside from our strong cultural mix, we're now in a position where our dependency is probably, and this is probably a good thing, is going to be across the board, not necessarily in one nationality. So there may be, there's maybe an advantage to that we really didn't see initially. So in that case, what we'd like to, as buyers and sellers and developers in the property and real estate agents in the property marketplace, what happens next is that we want to know where we think our money's coming from. So I'd like you to maybe give us an indication of what you think is going to happen to us over the next 3 to 6 months in relation to money coming in. So have you got any ideas on that? And I've said a lot, sorry, I've spoken a bit there.
No, that's okay. And you're right, and I think there's a lot going on in China, and obviously growth's probably cooled a bit over there.
Yeah, they're anticipating, I think, 6.8% or 6.5% growth over there from the original 9, but I think 6 plus is great.
Still pretty good.
Yeah,
still pretty good, and I think the demand for resources has probably plateaued. The mining companies here now they're in operation. There's no real investment. And that's been like that for a few years.
Although they made money, they've been making money, but they haven't employed any more people, which is all right. So therefore, they're more profitable than they were, but their employment rate hasn't gone up.
And interestingly, the Chinese government have brought in pollution policies.
Right.
And what that's done, it's had a benefit for Australian iron ore producers because the Chinese government has shut down all the really,
dirty plants.
The dirty mines, if you like. So the cleaner mines have to use high grade iron ore, and where do they get it from? Australia and Brazil.
Right.
So in effect, it's actually had a benefit, in the short term, because the Australian iron ore producers get better margin. But I think, with I can show you a graph, and it's a graph on the Chinese foreign exchange reserves.
Right.
And they were a few years ago about 4 trillion in a whole lot of reserves. And now that's whittled down. The graph's whittled down to about 3 trillion. So they've let all this capital. Okay. They've let all this capital go out of their country.
Yep.
And I think they've probably overdone it, like everyone does, and gone, oh, hang on a minute. Why are we letting all of our people, invest in assets outside our country? And I think there's a bit of a theme coming in to say, well, hang on a minute. You should be spending all your wealth in your own country. And I don't know, what the general consensus is about the Chinese people and their own government.
Yeah.
But I think once that sort of reserves level and it creates all sorts of economic issues, globally, having that much foreign exchange reserves.
Yes.
And I think they're just keeping their capital in. I mean, I've got an example of a client he's got a business over there, and she struggles to get money out. She's got, a business here that's struggling cash flow wise because she can't get money out of China. She's got $1 million tied up in the system over there. But that said, though, I think onshore here in Australia there is a lot of money around, in private wealth, and in the lending market, particularly for developers. There's been, a tightening of the banks around property development, but that has spawned a whole lot of new lenders and new players in the market.
Yeah.
That probably don't have the level of terms and conditions that the banks have. So developers and other people are getting access to capital, and it's just, the banks' property books go down and the private lenders go up.
Right.
I don't know how sustainable that is, and we've got to keep in mind the GFC didn't come about by the main banks. It came about by the non-bank lenders. They fell first, and everyone else came after.
Right. Okay, that's interesting.
Yeah. And I think, it's sort of. I think there's plenty of capital around. Next 3 to 6 months, the Chinese buyer, and I think you showed me this data. It was, I think, I don't know, a year ago there was 1 in 5 was Chinese or of that descent at an auction. I think now it's 1 in 20.
Yeah.
So I think that's actually not a bad thing.
I'd have to agree with that. I think that's
cooled the market a bit.
Yeah.
And I think you'll see the NAB forecast. I think for Melbourne and New South Wales, house prices are about flat in the next 12 months.
Yeah.
Maybe just slightly negative. Whereas some of the other cities that's it's on its way back again.
Well, the one that I saw, the report that I saw said that Melbourne was anticipated 2% growth, and so did Perth.
Yeah. Okay.
Right. Yeah. And that's what I mentioned in the previous video, and that Sydney and Adelaide and Queensland were touted as being a little bit in the negative, but not a lot. I'm talking like 0.8, under 1 point, right? So just from that perspective, it's the demographic mix and the cultural mix of our buyers, I think, is more pertinent today, especially from a real estate agent's perspective, right? That we know a little bit about who's coming into our market and who's not, and that we understand their culture when we're dealing with them.
Yeah.
Right. I think what we'll do is we'll sort of say, watch this space.
Yeah, I think so.
And we'll monitor this, and we'll keep you updated as we see policies change overseas with the US and China, etc., and go from there. But I think I think governments mandate to keep money within their own country. And what was happening in China is one of the things that changed in China was going back about 2 years ago, they actually had a property drop in value because there was so much money going out of the country. And that's why I think that their policy, if I was running their country, would be probably fairly similar, right? Because they need people to spend and invest in their own country, right? And they were having a mammoth amount of money going out of the country. So from that perspective too, and that policy that they've now implemented has actually probably stopped a lot of the overpaying here in our country, where we were getting exorbitant, excessive prices that were making it unrealistic, or though commercial properties were selling on 2% yield, like ridiculous stuff. So that seems to have leveled itself off a little bit.
There's a couple of other, if Australian interest rates stay where they are, and other countries goes up, then capital will flow with investment money to those countries to get a better yield.
Yes.
And also, I read interesting as well, like the tax cuts that, and just on Trump, what he's done. This is an interesting sort of fact. He's actually put in all these tax cuts and all this sort of stimulus at a time when America's got full employment, or very, very good employment numbers.
Yes. Yep.
So there's some.
What's that tell you?
There's some, and I think all the Reserve Bank, experts went over to the US, and they came back quite concerned. There could be a rapid rise, in interest rates if the timing of what he's done at a time when the US is at, pretty good employment numbers, or even almost close to full employment. Is it going to stimulate or spur, inflation and rapid growth?
Well, one of the things that I found is that in relation to some of my discussions with Dr. Fred and some of the people that he tutors and mentors over in the US, some states in the US have done really well, and some states have really not lifted from the regression 3 or 4 years ago. So on that score, and some of that's manufacturing based and some of it's employment based, and I've read those reports on the employment, but there is the New York Times about 3 weeks ago had a prediction that if the interest rates went up in the US, that they said that what would probably happen is it would give the marketplace some confidence, and that would stimulate investment purchases in residential housing, which is a different way of looking at it, right? Yeah. But they said that the US was now in a position where it actually needed to see some firmer government policies for people to get reboosted in their confidence levels. Yeah, so it's a different way of looking at it. So from that perspective, that's just something that we can monitor. But I think no matter what happens in the US, we need to very much monitor now the APRA and the banks, right, and the lending criteria. And it's the old routine. If you're very heavily debt leveled and the LVRs on your own home are very, very high, you've got to be careful about your next purchases. But if your LVRs are low on your own home, well, then maybe you look at investing. And what you do is, I think one of the things, especially here in Melbourne, there are some of these suburbs that are 10 to 15 k's out of the CBD, without me going into all the suburbs that they are, that are having a lot of development funding put into them, where they're building townhouses, etc. And townhouses seem to be very popular. But the main criteria for when I buy real estate, and you know this well, is that I look for where governments are spending their infrastructure money, where they're allocating infrastructure money for roads, transport, schools, etc. Those things matter, and that's where I'd spend development funding. And if I was just an investor that wanted to buy one investment property, they're the areas I'd also look in. Do you agree with that?
Absolutely.
All right. Well, look, on that note, we'll finish up. Thanks very much for listening. Take care. Have a great day.